The month of February was not a great month. March has been a little better, barely, but the S&P 500 is still down by a few hundred basis points. Now, a lot of the news that you see or content on YouTube and things like that all paints this picture of the sky is falling type of scenario. But when you look at the actual hard data, that's just not what we're seeing yet. It doesn't mean that things can't change and the data shows that the economy is dipping into a recession, but what we're seeing is simply not that case yet. A lot of these news agencies or certain YouTube channels are farming for clicks. I will never farm for clicks. In fact, I'm looking to push knowledge and facts. And the facts are right now is if you look at S&P Global, their latest expectations for the economy is to grow at a 1.9% clip each of the next 2 years, which is slower than the year prior, but nowhere near a recession. Slowdowns are part of the cycles that economies go through, but the important thing for you is to not overreact. No, it's not game over. No, it's not time to sell everything. It's time to focus on looking for opportunities in high quality stocks at great valuations. And in today's video, we're going to be taking a look at 5 stocks that I believe are approaching cheap levels and that should be high on your watch list to buy in the month of April. So before we unveil these stocks though, do me a huge favor, show your appreciation for these videos by simply clicking that like button down below. Subscribe to the channel and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 5 stocks for the month of April. And before we do that, there's reason to be excited about the turning of the page into the month of April. Because as you could see here, the month of April is historically the second best month of the year for the S&P 500, dating back decades upon decades of data. So let's hope that history repeats itself. And let's jump right into it with stock number 1, which is going to be Microsoft, stock ticker MSFT. When it comes to size, Microsoft is one of the largest companies in the world. They're one of the top 3 largest companies here in the US alone. But as I know, big things can fall hard. Taking a look here with the Mag 7 stocks, which are made up of Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet, and Tesla, only one stock is negative over the past 12 months, and that stock is Microsoft. Surprisingly enough, with the fall from grace we have seen from Tesla in 2025, the stock is still up over 50% in the past year. So what do we make of Microsoft? Well, there's been a few things that have caused headwinds for the company. Number one, really anything AI related has struggled in 2025. And since that DeepSeek news came out, it has tumbled a lot of AI related stocks. But as we know, Microsoft is much more than just AI. Sure, they own a large chunk of OpenAI, which also created the most popular AI platform in ChatGPT, but still, they are much more than that. They have cybersecurity, they have cloud, they have hardware, subscriptions, and the list goes on. Their popular cloud segment grew near 20% last quarter, and that amounts to roughly 40% of total revenues, and those revenues are high margin dollars. The company is getting cheap and looking real intriguing at current levels. The stock is trading 6% below their 200-day moving average, which is typically an area of support for many stocks, but Microsoft shares broke that support back in January. The stock currently trades at a forward PE multiple of 29.9 times, well below their 5-year average of 34.6 times. They also have an EV to EBITDA that currently sits at 20.6 times, which is again well below their 5-year average of 22.9 times. Analysts are also upbeat on Microsoft, rating the stock a strong buy with an average 12-month price target of $512 per share, implying 30% upside from current levels. And that leads us to stock number 2, which is going to be Broadcom, stock ticker AVGO. Broadcom, like Microsoft, is another stock that was a darling in years 2023 and 2024, and has since struggled in 2025. From the start of 2023 through the end of 24, shares of Broadcom climbed an impressive 315%. However, year to date, shares of AVGO are firmly in a bear market of their own, falling more than 20%. Enough is enough. Shares of Broadcom are definitely starting to look a lot more intriguing after this sell-off. But when it comes to these types of companies, they are not solely focused on AI. You can't compare Broadcom to the likes of NVIDIA. NVIDIA is all in on AI. But Broadcom, although they have a big area of AI, they also have a business that's software related. That could be outside of AI, whether it exists or not. And this is the common theme that you'll see across all of these companies that we're looking at here today. I like companies that have a diversified set of products, services, or offerings. Look here at the growth in terms of free cash flow for Broadcom since 2010. This company is printing cash. In terms of valuation, the stock currently trades at a forward PE multiple of 28.6 times, cheaper than Microsoft, but Broadcom is expected to grow their earnings at nearly triple the rate, at 35% year-over-year growth. That gives the stock a PEG ratio of just 0.82 times, making it look very intriguing. Analysts are also upbeat on Broadcom, rating the stock a strong buy, with an average 12-month price target of $252 per share, implying over 40% upside from current levels. Both of these first two stocks that we've looked at are firm positions within my portfolio. And if you're interested in seeing my entire portfolio, getting trade alerts anytime I enter or exit a particular stock, and also join my monthly members only meeting, then become a subscriber to the Stock Investor's Edge. Check out the link down in the description below. And that leads us to stock number 3, which is going to be Qualcomm. Stock ticker QCOM. Qualcomm has a lot of similarities to Broadcom, but there are some differences there. They do have that AI component, but they also have another area that I'm super excited about, and that is their presence within automotive. If you've purchased a brand new car in the past few years, you know the amount of technology that's within these vehicles. It's almost like you're riding with 50 computers inside of it. Over the past 12 months, shares of Qualcomm have gone nowhere, with the stock actually down 5%. It did reach a high of $230, but shares have since fallen more than 30% from those highs, putting the stock firmly in a bear market of its own, very similar to Broadcom. But looking closely at the chart, shares have been trading in a range between 150 and 175 for the past 6 months or so, and we're looking for that breakout higher. In terms of free cash flow, which is a favorite metric of mine to look at, this is another company that is printing cash, but they're not yet getting the credit for it. Over the past 12 months, Qualcomm has generated $13.8 billion in operating cash flow alone, which is a record high for the company. And they've generated free cash flow of $12.7 billion over that same time span. Shares currently trade with a free cash flow yield of 7.1%, which is absurdly high. The stock currently trades at a forward PE multiple of just 13.5 times, with a 15% expected EPS growth rate, meaning the PEG ratio is coming in below 1, again making Qualcomm look quite intriguing. Analysts are also upbeat on shares of Qualcomm, rating the stock a strong buy, with an average 12-month price target of $203 per share, implying 25% upside from current levels. And that leads us to stock number 4, which is going to be Vici Property, stock ticker VICI. Now let's move in to a REIT. And this happens to be the largest REIT holding within my portfolio. And if you look back over the past few months, the REIT sector has actually been the 4th best performing sector within the S&P 500, holding up quite well during this period of turbulence. And if you've been watching the news, what has really been claiming all of the headlines? It's been the talk of tariffs. And if there's one area where tariffs don't really impact, it's going to be Vici's business. They own hospitality and casino properties, and they lease them out to the likes of MGM, Caesars, and many other companies. They're not solely focused on the day-to-day gambling winnings. They're solely focused on their operators performing well and paying their rent. Analysts are looking for Vici to generate AFFO of $2.33 per share in 2025, which equates to a forward AFFO multiple of 13.6 times, which is well below their own 5-year average of 15.6 times. However, I believe this is a REIT that should trade at 16 times reasonably, meaning a stock price not at $32 per share like it is today, but closer to $37, implying nearly 20% upside from current levels. This is a company that deserves a bit of a premium. After all, they are the largest landlord on the Las Vegas Strip, owning properties such as Caesars Palace, MGM Grand, Park MGM, and the list goes on. So to me, there's plenty of upside. But in addition to that share price appreciation, Vici is cranking out a dividend that yields 5.5%, and it has been growing that dividend every year it has been a public company. Analysts are not as bullish as me on the stock over the next 12 months, but they still rate the stock a buy with an average 12-month price target of $35, implying roughly 10% upside to go along with that 5.5% dividend yield you would earn as a shareholder. Not a bad total return. And that leads us to stock number 5, which is going to be Prologis, stock ticker PLD. Why not close things out with yet another REIT? Something that won't have a ton of exposure to all of this tariff talk right here. This is a place that we can hide, look for share price appreciation, and gain a solid dividend that continues to grow. When it comes to Prologis, not only are they the largest REIT on the market, they are a warehouse and logistic REIT. But one area that they're looking to grow is that of data centers. And regardless of where you believe we are at in the chase and in the phases of AI, we do know that data centers are a requirement, a necessity. And we need to at least, at a very minimum, double the amount of data centers that we have here in the US. As I mentioned, PLD is the largest REIT on the market with a market cap of $103 billion. And when looking at their chart here, it has been pretty consistent. Start up at $130 per share, drop to around $100. Jump back up to $130 per share, drop back down to around $100. Then in February of this year, we're above $125. And look where we are approaching again, close to $100 per share. Around $100 per share has proven to be a great entry point, and eventually we're going to get that breakout higher. So with the stock approaching back around that $100 level, this is where I'm going to be looking to jump back into shares of one of my favorite REITs to build, that is Prologis. When it comes to PLD, although you do not get the same yield as Vici, you do get strong dividend growth as they have a 5-year dividend growth rate of roughly 12% and a dividend yield of 3.7%, which is still pretty solid, and they've been growing their dividend for 11 consecutive years. Analysts are looking for PLD to generate AFFO of $4.62 in 2025, which equates to a forward AFFO multiple of 24 times, which is below their 5-year average of 26.9 times. And the company has AFFO growth that's expected to be pretty solid for the next few years. Analysts are more bullish on PLD than they are Vici, as they rate the stock a buy with an average 12-month price target of $128 per share, implying roughly 15% upside to go along with that solid dividend and that growing dividend. So there we just looked at 5 stocks to consider buying in the month of April. There's a lot of talk out there and a lot of uncertainty on the horizon. But if history repeats itself, April has historically been a solid month for the markets. So let's hope history repeats itself. Down in the comments section, though, let me know which of these 5 stocks would you be most interested in adding to your portfolio. And if there's not one on here, put it down in the comments. I would love to hear that as well. And if you haven't done so, please show your appreciation by simply clicking that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.